Okay, let's dive deep into a topic that honestly can make a huge difference in how much wealth stays with your family versus, well, going to taxes.
It's a really important one.
Imagine this. You've got some property, maybe stocks, maybe a house held for years, decades even. It's shot up in value.
Which sounds great, right? Yeah.
Absolutely. Fantastic news for your net worth. But
Yeah.
if you sell it now, you're probably looking at a pretty hefty capital gains tax bill on all that growth.
That potential tax hit is a major factor in planning. It's like a built-in gain just waiting for a taxable event, like selling it.
Yeah, and if you're thinking about passing it on, maybe gifting it to your kids while you're alive, they could face that exact same tax headache down the road when they sell.
That carryover tax liability can be enormous,
Yeah.
especially for assets held a long, long time. A huge potential burden for the next generation.
It almost feels a bit unfair, doesn't it? You build this value over a lifetime and then poof, a big chunk might vanish in taxes when it changes hands. But this is where this crucial, often misunderstood concept comes into play. It's called the step-up in basis.
Such a critical term.
Seriously, for anyone who might inherit assets or anyone planning their own estate, getting your head around this rule isn't just, helpful. It can be absolutely transformative for the tax outcome.
It really is. It's one of the most powerful tax provisions out there for inherited assets. It basically hits a reset button on a tax cost when someone passes away.
A reset button, I like that. So our mission today in this deep dive is to unpack the step-up in basis rule here in the U.S. We're digging into our sources, insights from financial advisors, research, and really importantly, the official IRS guidance, especially Publication 551. That one's all about asset basis.
Right. Pub 551 is key.
We'll break down what basis even means, how it gets adjusted, how the step-up actually works, how different ways of owning property change things.
And things like depreciation, losses, how they fit in, and what you should be thinking about for your own planning, especially since things could, potentially change in the future.
Exactly. Our goal is to arm you with a solid grasp of these, let's be honest, pretty complex rules.
And we'll show you why inheriting assets is often way more tax-friendly than getting them as a gift while the owner's alive. It's all because of this basis adjustment.
The difference in tax savings for your heirs can be just staggering.
It really can.
It's about making sure your legacy gives the maximum benefit without these huge unexpected tax bills popping up. So, okay, before we can really get the step-up part, we need to lay the foundation. What exactly is basis in the tax world?
Okay, think of basis as, well, it's your investment stake in a property for tax purposes.
Yeah.
Your cost foundation. IRS Pub 551 defines it pretty simply. It's your investment in the property.
Your investment?
Yeah, and it's the starting point for a lot of tax calculations related to that asset over its life.
So it's more than just the price you paid initially.
Oh, definitely. Its function is really broad.
Yeah.
Pub 551 lists several key uses. You needed to figure out depreciation deductions if it's a business or rental asset, amortization for intangibles, depletion for things like oil wells, and calculating any casualty or theft loss you might claim.
Right.
But maybe the most common use, the one most people bump into, is calculating your gain or loss when you finally sell or get rid of the property, your selling price minus your adjusted basis. That's generally your gain or loss.
Got it. So it's the anchor point for that future tax event. And the most common type, the one we usually start with, is cost basis. How do we figure that out?
Cost basis is definitely the starting point for most assets you buy. Pub 551 says it's generally what you pay in cash, debt you take on like a mortgage, the value of other property you trade, or even the value of services you perform to get the property.
Okay.
But crucially, it also includes certain other costs you incurred to actually acquire or produce the property.
Like what kind of costs are we talking about here from the IRS's view?
Pub 551 gives a pretty good list. When you buy property, you often include things like sales tax you paid, freight or delivery charges, installation and testing costs to get it ready for use, certain excise taxes. If you paid legal or accounting fees specifically for the purchase, and you can't deduct them immediately as a business expense, you add them to the basis. That's called capitalizing them.
Capitalizing, okay.
You also add things like revenue stamps, recording fees for the deed, and even real estate taxes the seller owed, but you paid at closing if you weren't reimbursed.
So stuff beyond the price tag itself, but necessary to actually get and own the property.
Exactly. Think about settlement fees and closing costs. Pub 551 is specific. Costs for buying the property like brokerage commissions, fees for preparing the deed, your attorney's fees for the purchase, title search, title insurance. Those generally get added to your basis.
Okay, that makes sense for the buying part. What about all the fees connected to getting a loan, like a mortgage? Do those get added to the property's basis?
Good question. That's a common mix-up.
Ah.
Pub 551 draws a clear line here. Costs related to getting the loan are generally not added to the basis of the property itself. So things like points you pay on the mortgage, unless they meet very specific rules for being deducted as home mortgage interest. And even then, seller-paid points actually reduce your basis. They don't increase it.
Okay, tricky.
Right. Mortgage insurance premiums, loan assumption fees, costs for credit reports, or appraisals that the lender requires, those are generally not added to the property's basis. Refinancing costs are separate too.
So they might be deductible somewhere else or over time, but they don't pump up the basis of the actual asset.
Exactly right. Loan costs are financing costs, not asset acquisition costs. Pub 551 also covers property you build yourself.
Okay.
The direct costs, land, materials, labor you pay for, contractor payments, architect fees, building permits, those all go into your basis. But it specifically says the value of your own labor or unpaid labor from family or friends, that doesn't count towards your basis.
What? My weekend sweat equity doesn't increase my basis. I feel robbed.
I know, right? It feels like it should, given the effort, but the tax code focuses on actual money spent or property exchanged.
Okay, fair enough. What about businesses? I know there are special rules there.
Yes, for businesses, Pub 551 brings up the Uniform Capitalization Rules, often called UNICAP. These are, well, they can be pretty complex. They basically require businesses to capitalize, meaning add to basis or inventory cost, a lot of direct and indirect costs of producing property or acquiring property for resale, instead of deducting them right away.
So instead of getting the tax break immediately, they add it to the assets cost, and the tax benefit comes later through depreciation or when it's sold.
You got it. The cost is recovered over time or at sale. But there's an important out for many businesses. Pub 551 notes exceptions for small businesses. For tax years starting in 2024, if your average annual gross receipts for the last 3 years are $30 million or less, you're generally exempt from UNICAP.
$30 million? That's quite a high threshold for a small business exemption.
It is. It definitely helps a lot of businesses avoid those tricky capitalization rules. The threshold is also adjusted for inflation, so it might go up.
Good to know. Okay, beyond regular property, what about intangible things like goodwill or patents?
Pub 551 touches on those too. Intangibles like goodwill, patents, copyrights, trademarks, their basis is usually their cost, whether you bought them or created them. For things like patents and copyrights, it includes costs like legal fees, development expenses, clerical help, but again, not the value of the inventor's or author's own time and effort.
The creative spark itself doesn't get a basis, but the costs to develop and protect it do. Okay. Now, what if you buy a bundle of assets all at once, like land with a building, or maybe you buy a whole small business? One price, multiple assets.
Yeah, that happens all the time, and it brings up the need to allocate basis. Pub 551 says when you buy a package deal for one price, you have to divide that total cost among the individual assets. And you do that based on their relative fair market value, or FMV, at the time you bought them.
Relative FMV. So how much each piece was worth compared to the others?
Exactly. For land and a building bought together, you split the cost based on their FMVs. This is super important because land isn't depreciable, but the building usually is. So that allocation directly impacts your future depreciation deductions.
How do you figure out the FMV appraisals?
Appraisals are best. Sometimes people use assessed values from property tax records as a starting point for the relative values, but those aren't always accurate reflections of true market value.
Okay. And for buying a whole business?
That's even more structured. You have to allocate the purchase price across all the assets you acquired, tangible stuff like equipment, inventory, buildings, land, and intangible assets like goodwill, customer lists, maybe a non-compete agreement. The IRS actually makes you use a specific form, Form 8594, Asset Acquisition Statement, to report how you allocated the price among 7 different asset classes.
7 classes. Okay, structured indeed. What about subdividing land? Buy a big plot, cut it into smaller lots to sell.
Similar principle. Pub 551 says you allocate the total cost basis of the original big tract among the new smaller lots. Usually, this allocation is based on the relative FMV of the lots after you've subdivided, but before you start selling them. So the more valuable lots get a bigger piece of the original cost basis.
That makes sense. Each individual piece needs its own starting number for taxes later on. Okay, so that's cost basis, our starting point, sometimes allocated. But you mentioned it's not static, it changes. That gets us to adjusted basis.
Correct. Adjusted basis, according to Pub 551, is your original basis plus certain increases and minus certain decreases that happen while you own the property. It's like a running tally of the property's tax history with you.
What kinds of things increase your basis?
The most common increases are from capital improvements.
Yeah.
These aren't just minor repairs. They're significant costs that add substantial value, extend the property's useful life, or adapt it for new uses. Like adding a whole new room, putting on a completely new roof, installing central AC if it didn't have it, maybe replacing all the old plumbing or wiring. Pub 551 also lists things like significant landscaping, paving a driveway, costs to extend utility lines to the property, impact fees for new construction, legal fees to defend your title or get zoning changed, and also assessments from your local government for improvements like sidewalks, streets, sewer lines, if they benefit your property.
So costs that really enhance the property long-term, not just patch it up.
Precisely. They're investments in the property. Pub 551 also mentions you sometimes have a choice to capitalize certain costs instead of deducting them right away, like carrying charges, interest and taxes on undeveloped land, or certain exploration costs for resources. If you choose to capitalize them, they increase your basis.
Okay, those build it up. What brings it down? What decreases basis?
Decreases often relate to getting some kind of tax benefit or cost recovery already. Pub 551 gives a bunch of examples. The big ones are deductions you take, like Section 179, expensing for businesses.
Right, writing off equipment quickly.
Regular depreciation deductions over the asset's life, amortization, depletion, those all reduce your basis because you're recovering your costs through deductions. Also, if you have a casualty or theft loss, any insurance money you get back or any loss deduction you claim reduces your basis.
Okay.
Other things include canceled debt that you didn't have to count as income, like maybe on a principal residence during certain periods, rebates you get from a manufacturer after buying something, payments you receive for granting an easement on your property that reduces the basis of the part affected, even things like the gas guzzler tax on a car, or certain energy credits or adoption tax benefits if they were tied to basis.
So things that reduce basis are often about getting your cost back over time, like depreciation, or getting some other benefit or compensation related to the property.
That's a good way to put it. Pub 551 is a nice, simple example. So you buy a factory building for $100,000.
Yeah.
You had a $10,000 improvement. You claim $30,000 in depreciation over the years. Then you have a $5,000 casualty loss deduction. Your adjusted basis becomes $100,000 original cost plus $10,000 improvement, $30,000 depreciation, $5,000 casualty loss, equals $75,000. That $75,000 is your new starting point for figuring gain or loss if you sell it.
So the adjusted basis is this really crucial dynamic number that reflects everything that's happened tax-wise during your ownership. Tracking it seems essential.
Absolutely essential. And honestly, keeping meticulous records, receipts for improvements, records of depreciation claimed over potentially decades. It's non-negotiable. Without good records, figuring out your correct adjusted basis when you finally sell can be, as one of our sources put it, extraordinarily difficult.
And you could end up paying more tax than you owe or reporting incorrectly.
Exactly. You need that proof.
Okay, that gives us a solid understanding of basis, cost basis, adjusted basis. Now let's shift gears to where the step-up really comes into play. We've talked about basis when you buy or build something. What about when you get property from someone else, specifically through inheritance?
Right. This is where the rules often take a sharp turn from the cost basis method. As Pub 551 points out, basis for inherited property, or even property received as a gift during life, is often determined differently. Sometimes it's fair market value, sometimes it's the old owner's basis.
And the big one, the reason we're here, is inherited property. This is the heart of the step-up rule. How does it work?
The general rule, and this is consistent across the IRS, Smart Asset, Eagle Strategies, all our sources, is that the basis of property you inherit from someone who died gets adjusted. It gets adjusted to the fair market value, FMV, of that property on the date the person died.
So not what they paid for it, not their adjusted basis, but what it was actually worth on the day they passed away.
Exactly. That date of death FMV becomes the new basis for the heir, the person inheriting it. Now, there are a couple of rare exceptions, like if the estate chooses an alternate valuation date, which is 6 months after death, or uses a special use valuation for certain farms or businesses. But for most inherited assets, FMV on the date of death is the rule.
And FMV, fair market value, just means?
Pub 551 defines it as the price the property would sell for on the open market, between a willing buyer and a willing seller, neither being forced to act and both knowing all the relevant facts. Appraisals are common for things like real estate or unique items. For stocks traded on an exchange, it's usually pretty simple, the closing price on the date of death.
Okay, so the basis becomes the FMV at death. Now, the big question. Why is this such a big deal? What's the practical impact when the heir goes to sell that asset?
The impact on capital gains tax is huge. Both Eagle Strategies and Smart Asset really hammer this point home. Because your new basis is the FMV at death, any capital gains tax you owe when you sell is calculated only on appreciation that happens after you inherited it.
So all the appreciation that occurred during the original owner's lifetime.
Wiped clean. For capital gains tax purposes for the heir, it's effectively gone. That appreciation up to the date of death becomes tax-free if you sell at or near that inherited value.
Let's nail this down. Use that classic example. Grandpa bought stock for $10 a share ages ago. He dies, and it's worth $100 a share. You inherit it. What's your basis? What happens if you sell?
If you inherit it, boom. Your basis is immediately $100 per share, the FMV at death. If you sell it a month later for, say, $105 a share, your taxable capital gain is just $5 per share. $100 sale price minus $100 stepped up basis.
Just $5 gain.
Right. The $90 of appreciation that happened while Grandpa held it, $100 FMV minus his $10 cost, never taxed to you as capital gains.
Okay, $5 taxable gain. Now contrast that, as Eagle Strategies and Pub 551 do, with the other scenario. What if Grandpa had gifted you that same stock while he was alive? Say it was worth $95 when he gave it to you.
Big difference here. If he gifted it to you during his lifetime, you generally take his original basis, that $10 per share. This is often called a carryover basis. You step into his tax shoes cost-wise.
So my basis is $10.
Right. So if you then sell that stock for $115 per share later on, even if it dropped back to $100 at his death, that's irrelevant because you got it as a gift earlier. Your taxable capital gain would be $105 per share. $115 sale price minus your $10 carryover basis.
Wow. Okay, let's just pause on that. Inherited scenario. Sold for $105 taxable gain. Gifted scenario. Sold for $105 taxable gain. That difference is massive. $100 per share more in taxable gain just because it was a gift instead of an inheritance.
It's an enormous difference. Smart Asset has a great house example too. Parents buy a house for $50,000 way back. They pass away, it's worth $800,000. You inherit it. Your basis is stepped up to $800,000. Sell it for $800,000. Zero capital gain.
Zero gain.
Now, they had gifted it to you while alive. Your basis would likely be their $50,000 cost. Sell it for $800,000. Now, you've got a $750,000 taxable capital gain. That could literally mean hundreds of thousands of dollars in tax saved just by inheriting instead of receiving it as a gift.
The takeaway seems incredibly clear then. For assets that have appreciated a lot, holding them until death, so heirs inherit them, is way more tax efficient for capital gains than gifting them during life.
Absolutely. Eagle Strategies points this out as a key planning point. That lifetime appreciation, which is often the biggest chunk of the gain, effectively disappears for tax purposes if the heir sells around the inherited value. It's why people with significant appreciated assets often focus their estate plan on ensuring these assets pass at death.
So if you do want to make gifts during your lifetime,
it's usually smarter, tax-wise, to gift assets that haven't appreciated much, or maybe even have a loss. That way, the carryover basis doesn't saddle the recipient with a big future tax bill.
This step-up benefits sound amazing, almost too good to be true in some cases. But how does the way you own the property affect it? Does it matter if it's in one name, jointly owned, community property, in a trust?
Oh, it matters a lot. Ownership structure is absolutely critical in figuring out how and how much of the step-up applies. Spark Financial Advisors and the IRS Pub give us the details here.
Okay, let's start simple. Property owned individually. Just one person's name on the deed or account.
If it's owned solely by one person, Spark confirms it generally gets a full step up in basis to the FMV at the owner's death. Doesn't matter if you're in a community property state or not, own it alone, you die, the whole thing gets the basis reset.
Full step up. Straightforward. Okay, now the common scenario. Jointly owned property. Say a married couple in a separate property state. Maybe they own it as joint tenants with right of survivorship or tenants in common.
This is where it gets more nuanced, and that Spark article example with Daniel and Jill is perfect. In separate property states, if property is held jointly, and it's not community property, each co-owner usually has a basis reflecting their share or contribution. When one co-owner dies, only the decedent's portion gets the step up to FMV at death.
Only their half, typically for spouses.
Generally, yes, for spouses under current rules. The surviving co-owner's basis in their original share, it stays exactly the same. No step up on their part.
Okay, walk us through Daniel and Jill again. Bought for $100, so $50K basis each, worth $400 now. Daniel dies. His half is worth $200K.
Right. So Daniel's $50K basis and his half gets stepped up to the $200K FMV of his half.
Okay.
Now, Jill, the survivor, her new total basis in the whole property is her original $50K basis in her half, plus Daniel's stepped up $200K basis in his half. Add them together. $50K plus $200K equals $250K. That's her new basis for the entire $400K property.
So even though the property's worth $400K and she owns it all, her basis is only $250K. If she sells it right away for $400K, she still has a taxable capital gain of $150,000. $400K minus $250K basis.
Exactly. The step-up only eliminated the gain on Daniel's half. The gain built into her original half, $200K FMV of her half minus her $50K basis, the $150K gain is still there, waiting to be taxed if she sells.
That's a really important distinction compared to other ways of owning it.
Absolutely. It leads right into community property.
Right. Community property states, Pub 551 lists them. Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, Wisconsin. What happens with married couples there?
Community property states offer a huge advantage here. Pub 551 explains that when one spouse dies, generally the entire community property asset, both the deceased spouse's half and the surviving spouse's half, gets a full step-up in basis to FMV at the date of death.
Both halves, the whole thing.
The whole thing, provided at least half the value of the community property interest is included in the deceased spouse's estate, which is typically the case.
So same Daniel and Jill example. Bought for $100K, worth $400K at Daniel's death, but now they live in, say, California, and it's community property.
If it's community property, when Daniel dies, Jill's basis in the entire property becomes $400,000, the full FMV.
Wow. So if she sells it right away for $400.
Zero taxable gain, $400K sale price minus $400K stepped up basis. Compare that to the $150,000 gain in the separate property state scenario.
That is a massive difference, just based on where you live and how the property is titled between spouses. Community property looks very attractive for appreciated assets.
It absolutely is. From this specific tax perspective, it provides that full basis reset, wiping out all the lifetime appreciation on both halves.
Okay. Pub 551 also talks about other joint tenancies, maybe non-spouses, or rules based on contributions. It had that John and Jim example that looked complicated.
Yes, the rules for surviving joint tenants can get very complex, especially for non-spouses or older joint tenancies. The John and Jim example involved tracing who contributed what. John put in 2/3, Jim 1/3. Property cost $30K, worth of $60K when John died.
Okay.
Because John contributed 2/3 of the value, $40K goes into his estate. Jim's new basis starts with his original cost, $10, adds the inherited value, $40K, but then gets reduced by depreciation attributable to John's share before death. The calculation gets fiddly, relying on contribution tracing and specific depreciation rules. It ended up being $44K in that example.
That sounds like a record-keeping headache compared to the community property rule.
It definitely can be. Tracing contributions decades later, tough.
Yeah.
However, for married couples holding property as joint tenants with right of survivorship or tenants by the entirety, and they're the only owners, Pub 551 gives us the qualified joint interest rule. This simplifies things a lot.
Qualified joint interest. Okay, what's the rule?
For these qualified joint interests between spouses, it doesn't matter who actually paid for the property. Exactly 1/2 of the value is included in the estate of the first spouse to die.
Just half, automatically.
Automatically half. And the surviving spouse's basis. Pub 551 says it's their original cost basis in their half, adjusted for any depreciation they took, plus the basis of the inherited half. And that inherited half's basis is half the FMV at death.
So that sounds like it leads to the same result as the Daniel and Jill separate property example. Only half gets the step up.
Functionally, yes. For a qualified joint interest between spouses, the net result is usually that only the deceased spouse's half gets the basis step up. The survivor keeps their old basis on their half.
Okay, let's recap ownership. Individual, full step up, usually. Joint between spouses in separate property states or qualified joint interest. Step up on the deceased's half only. Community property states. Full step up on both halves for spouses.
That's the crucial summary. Still, law and titling matter immensely.
What about trusts? People use trusts all the time in estate planning. Do assets inside a trust get a step up?
Trusts. It completely depends on the type of trust, as Eagle Strategies explains. For a revocable trust, one you can change or cancel during your lifetime, assets held inside it generally do get a step up in basis when the grantor, the person who set it up, dies.
Why is that?
Because for estate tax purposes, assets in a revocable trust are usually considered part of the grantor's taxable estate. You still control them, essentially. Since they're in the estate, they qualify for the basis adjustment.
Makes sense. What about your revocable trusts? The ones you generally can't change.
Assets held in a standard irrevocable trust typically do not get a step-up in basis when the grantor dies.
Ooh, step.
Generally, no. When you put assets into a true irrevocable trust, you give up ownership and control. Those assets are usually considered outside your taxable estate. And since the step-up is tied to assets included in the estate.
If it's outside the estate, it doesn't get the step-up.
Exactly. The beneficiaries would generally inherit the assets with the trust's basis, which often traces back to your original basis when you put the assets in, a carryover basis.
So putting highly appreciated stock in an irrevocable trust might protect it from estate tax, but you could lose the step-up benefit for capital gains for your heirs.
That's the typical trade-off, yes.
There's always a but in tax, isn't there?
Huh. Seems like it. Eagle Strategies mentions some advanced planning strategies. Certain types of marital trusts, like QTIP trusts, can be structured to get a step up at the first spouse's death and potentially again at the surviving spouse's death, a so-called double step-up.
Double step-up.
Interesting.
And they also mention techniques with certain irrevocable trusts, known as grantor trusts. Even though it's irrevocable, the grantor might still be treated as the owner for income tax purposes. Some of these trusts have swap powers, letting the grantor exchange assets of equal value between their personal holdings and the trust.
Swap powers.
Yeah. A planner might advise the grantor, maybe shortly before death, to swap low-basis appreciated assets out of the trust and into their personal name, in exchange for putting cash or high-basis assets into the trust. The appreciated assets are then positioned to get the step-up when the grantor dies.
Wow. Okay, that sounds like really sophisticated planning. Definitely not DIY territory.
Absolutely not. These require highly specialized legal and tax advice. But it shows that the trust type and its specific provisions are key, and sometimes there are ways to plan around the general rules.
We've talked a lot about avoiding capital gains. But what about assets like rental properties that involve depreciation over time? How does the step-up interact with that? And something called depreciation recapture. Great question. This is a really important benefit for real estate investors, and Spark Financial Advisors breaks it down well. So owners of rental properties deduct depreciation each year, right? Based on the building's basis.
Right. It offsets rental income.
Exactly. It's a valuable deduction. But as we said earlier, claiming depreciation reduces your adjusted basis.
Which increases the potential gain when you sell.
Precisely. And there's another catch. Spark notes that when you sell rental property at a gain, the government wants back the tax benefit you got from those depreciation deductions. That's depreciation recapture.
Recapture? How is it taxed?
It's taxed at ordinary income rates, but there's currently a maximum federal rate cap, often cited as 25%. Specifically for this type of recapture on real estate depreciation, called unrecaptured Section 1250 gain.
Okay, so you get the deduction, but pay tax on it later at potentially favorable rates, but still it's a tax. How does the step-up affect this recapture?
This is where the step-up is incredibly powerful for depreciated assets. When an inherited property, or the inherited portion of it, gets that step-up in basis to FMV at death, the accumulated depreciation tied to that stepped-up portion is generally wiped away.
Wiped away. Gone.
Gone. Spark puts it just like that. The heir inherits the property, or the share, with a new, clean basis, the FMV. And they can start a new depreciation schedule based on that new higher basis if they continue to rent it out.
So if I inherit a rental property my parent owned outright, and they depreciated it way down, I don't inherit their recapture tax problem.
Generally, that's correct for the portion that gets the step-up. If they owned it 100% and it gets a full step-up, all their accumulated depreciation vanishes for recapture purposes. If you sold it right after inheriting, you'd likely have little or no capital gain, basis FMV, and no depreciation recapture tax from their ownership period. Fresh start.
What about our joint ownership example, Daniel and Jill? If it was a rental in a separate property state, only Daniel's half gets the step-up.
Good point. Spark clarifies this. In that case, only Daniel's half of the accumulated depreciation gets wiped out by the step-up on his share. Jill, the survivor, still has her original basis in her half, and all the depreciation attributable to her half is still potentially subject to recapture if she sells.
So she'd owe recapture tax on her share's depreciation, but not his.
Exactly. The step-up cleans the slate, but only for the part of the asset that actually received the basis adjustment.
Okay, that makes sense. Now, another thing with rentals is losses. Sometimes expenses and depreciation are more than the rent income. passive activity losses, or PLs.
Right. Passive activity losses often happen with rentals. The tax rules generally say you can only deduct these passive losses against passive income. If you don't have enough passive income, the losses get suspended and carried forward to future years.
Carry forward indefinitely.
Pretty much, yes. To offset future passive income, or they can often be fully deducted when you sell the entire activity that generated them. They can build up over years and represent a valuable future tax asset.
So you have these potentially valuable carryover losses. What happens to the deceased owner's share of those losses when they die? Do they get stepped up too?
Here's where the news isn't as good, according to Spark. Unlike basis, the deceased person's share of suspended passive activity losses is generally lost at death. They just disappear.
Vanish. They don't transfer to the heir or the surviving spouse?
No, they typically don't carry over to be used by the heir in future years. However, Spark points out a small silver lining. Those suspended losses can usually be deducted on the deceased person's final income tax return.
Final return, how does that work?
They can generally be used to offset any income, passive or non-passive, on that final return, but there's a catch. They're only deductible to the extent they exceed the amount of the basis step-up. So the step-up amount effectively reduces the loss allowed on the final return. Any loss remaining after that reduction is deductible against any income.
So there's an interaction with the step-up. Some loss might be usable on the final return, but maybe not all of it if the step-up was large.
It's complex. But the key takeaway is that the carry-forward potential beyond the final return is generally lost. Spark suggests this could be a planning point. If someone is near death with large suspended PLs, maybe try to generate some income in that final year to soak up some of those losses before they're reduced or eliminated.
That's a somber planning thought, but practical. So it's a mixed bag with rentals at death. Step up is great for capital gains and wiping away a depreciation recapture on the inherited part, but you generally lose the future benefit of the deceased's carryover passive losses.
That's a perfect summary. Important to understand both sides.
Okay, this all leads us directly into planning. Given the huge tax difference between step up at death for appreciated assets versus gifting them, what are the main takeaways and strategies people consider?
The number one takeaway, echoed by Eagle Strategies and Spark, is simple. Leverage the step up. If you have assets that have appreciated significantly, holding on to them until death is usually the most tax-efficient way to pass that value on, specifically regarding capital gains tax.
So be strategic about what you gift versus what you hold.
Definitely. As we said, consider gifting assets with low appreciation or even losses during your lifetime, and earmark the highly appreciated assets for inheritance.
What about married couples in separate property states where joint ownership only gets that half step up? Are there strategies they might consider to try and get a full step up?
Spark does mention a strategy people sometimes discuss, but they rightly flag it as risky. It involves intentionally putting the title of an appreciated asset solely in the name of the spouse who is, maybe based on age or health, considered more likely to pass away first.
The idea being, if that spouse owns it 100% when they die, the whole thing gets a full step up.
That's the goal. Instead of the guaranteed half step up from joint ownership, you're aiming for a full step up by concentrating ownership in the spouse expected to die first.
That sounds like a gamble. What's the big risk?
The huge risk is, you might be wrong. Life is unpredictable. What if the other spouse, the one whose name isn't on the title, dies first? Then the asset owned solely by the survivor gets no step up at all at that first death.
Ouch.
Yeah. The survivor is then stuck with the original low basis on the entire asset, potentially facing a massive tax bill if they sell later. You gave up a certain half step up for the chance of a full one, and if it backfires, you get nothing at the first death.
That's a really significant risk. And isn't there also a specific IRS rule about gifting appreciated property to someone who then dies soon after? Like, you can't just give it to someone on their deathbed and get it right back stepped up.
Exactly. Both Pub 551 and Spark highlight this anti-abuse rule, often called the one-year rule. If you gift appreciated property to someone, and that person dies within 1 year of receiving the gift, and the property then passes back from them to you, the original donor, or to your spouse, then you do not get the step up in basis. Your basis in the inherited property is limited to whatever the decedent's adjusted basis was right before they died, which, because they received it as a gift from you, is likely your original low basis.
So no quick round-tripping gifts to snag a step up within a year if it comes back to the donor or their spouse.
Precisely. It prevents using a dying individual as just a temporary holding spot to wash the gain out of an asset.
Makes total sense. Okay, looking ahead then, this step-up rule is obviously incredibly valuable. Is its future rock solid?
Well, that's the million-dollar question, isn't it? Eagle's strategies touches on this uncertainty. They point out that proposals have definitely been floated in Washington over the years that could eliminate or significantly change the step-up in basis rule.
Like what kind of proposals?
For instance, they mentioned the preliminary Biden tax plan discussed around the election, which included ideas about eliminating the step-up, maybe above a certain exemption amount or based on wealth levels.
What's the reasoning usually given for wanting to get rid of it?
Eagle Strategies notes a couple of main arguments usually put forward. One, the current rule encourages people to hold on to appreciated assets until death, the lock-in effect, rather than selling them and realizing gains during life. Eliminating step-up might encourage more lifetime sales.
Okay, unlock capital.
Right. And two, it's seen as a way to increase federal tax revenue by making sure that appreciation is eventually taxed when the asset is transferred or sold by the heir, which often doesn't happen now.
If they did eliminate it, what would be the practical challenges?
Eagle Strategies highlights a major one: basis tracking. Imagine heirs trying to figure out the original cost basis for stock bought 50 years ago, or a family property held for generations. Finding those records could be incredibly difficult, making gain calculation a nightmare.
Yeah, I can see that.
And it could also potentially lead to situations where very large estates pay both estate tax and then the heirs pay capital gains tax on the same appreciation when they sell. Kind of a double hit.
That would be a massive change to how wealth transfer is taxed.
It really would. Now, whether any changes will actually happen and what form they might take is totally uncertain. But the fact that it's even discussed highlights why understanding the current rules and planning accordingly is so important.
So the message isn't to panic about potential changes, but to be aware and make sure your current plan works under today's rules.
Exactly. Review your plan with advisors. And Spark Financial Advisors offers that great piece of wisdom. Don't let the tax tail wag the dog. Meaning, yes, tax efficiency is important, and the step-up is a powerful tool. But your fundamental decisions about buying, holding, or selling assets should be based on sound investment principles and your overall financial goals, not just chasing a tax break for your heirs years down the road. The asset itself needs to make sense.
That's a really important grounded perspective. Keep the big picture in mind. And given everything we've talked about, basis calculations, adjustments, ownership rules, depreciation, trust, potential changes, trying to figure all this out on your own seems unwise.
Extremely unwise. All our sources, Smart Asset, Spark, Eagle Strategies, even the IRS publications, implicitly emphasize the complexity here. Basis, capital gains, estate planning, depreciation. It's intricate and depends entirely on your specific facts.
So professional advice is key.
Absolutely essential. We strongly echo the recommendation to consult with qualified professionals. A CPA who understands this stuff, a tax attorney, a financial advisor specializing in estate planning. They can look at your situation and help you navigate these rules correctly.
Getting that personalized advice seems like the only way to really make sure you're doing the right things for your specific assets and your family.
Without a doubt, it's the only way to be confident you're making informed decisions for your legacy.
Okay, let's try to wrap this up. We started this deep dive by defining basis, your tax investment cost, in property. We looked at how cost basis includes the purchase price plus other acquisition costs, but usually not financing fees.
Right, and how that basis gets adjusted over time, increased by capital improvements, decreased by things like depreciation or casualty losses. That running tally is your adjusted basis.
Then we hit the main event, basis for inherited property. The powerful step up in basis, resetting the heir's basis to the fair market value at the date of death.
And we contrasted that sharply with getting a gift during life, where you typically get stuck with the donor's lower original basis, leading to potentially much higher capital gains taxes later on.
We also saw how critical ownership structure is. Individual ownership often gets a full step up. Joint ownership in separate property states usually only steps up the deceased's half.
Whereas community property states generally grant that amazing full step up on both halves for married couples and trusts. Revocable ones usually allow the step up. Standard irrevocable ones typically don't unless there's specific advanced planning involved.
And we looked at depreciation, how the step up can wipe the slate clean on accumulated depreciation recapture for the inherited portion, giving heirs a fresh start.
But we also learned that carryover passive activity losses from the decedent generally don't transfer to the heir. They're mostly lost, though some might be usable on the final return.
Finally, we touched on planning points. The riskiness of trying to game ownership between spouses, the IRS one-year rule blocking certain gift-back schemes, and the background noise about potential future changes to the step-up rule itself, all pointing towards the need for careful planning and professional advice now.
Understanding all these pieces is just fundamental if you're concerned about passing on wealth efficiently from a tax perspective.
So here's the final thought we want to leave you with today. Passing on your assets isn't only about the dollar value you've built up, it's also very much about the tax value you can preserve for the next generation.
That's well put.
Thinking strategically about how you own your assets and when they transfer, really understanding basis, adjusted basis, and especially the impact of that step up at death. It's not just dry tax planning. It's a crucial part of making sure your legacy actually provides the financial security and the benefit you intend for the people you care about. It's about unlocking the true potential of what you've built.
It's complex, no doubt, but getting it right can make an enormous difference down the line.
We really hope this deep dive has helped shed some light on this powerful and complicated concept for you.